Hello, investors and traders, and welcome to the weekly market report. I'm Magee, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. As I do each and every week, I leave my lines on the chart from the previous forecast so you can see how the projections worked out. And right here was last Friday, and I drew that diagonal line down, showing a target of 311.38. That's known as a zip line. That's what I call that when I do my forecast. You can see back here, these are previous forecasts where the end of the line represents the target. And as you can see, not only did we hit that target on the diamonds, but we gapped down below this support level in the process. So what does that mean for next week? Well, here's the good news for anyone that's looking for a bounce. I would say use caution. Number one, I do believe that we can see a bounce, and it's not my opinion. It is basically what I'm seeing in the chart. Now, with that said, the bounce that I'm talking about is going to be very short-lived. I think that we could see a rally right up to the previous support level here, which is now resistance. Remember, if you're following along, I talk about this role reversal line where once that support is broken, it turns into resistance. So that's where I think we could see the rally. And in putting my forecast here, I'm just going to draw that zip line. Look what I'm doing. I'm drawing to the right as I look to the left. And what I'm doing is I'm basically taking the angle that we see in these short-term rallies. See, this angle is very consistent, even back here. Pretty much the same angle as what I just drew. Now, it's not a long duration in that leg, mainly because we're still in a bear market. So as we rally into next week, remember it's a shortened trading week next week, there's only 4 trading days, I do believe that there will be new short selling as the short sellers wait with patience for a rally, and they'll try to sink their teeth into a higher price level before they sell it. So once we rally, you have to understand that there's a gap up here as well that will act as a price magnet. Whether or not these gaps fill, we'll have to see, but they'll still help to draw the price up, at which time I do believe we're going to start to see a pullback from that resistance point. Now keep that in mind. My longer term targets for the general markets are way down, and I know I'm putting my neck out when I do this, but I'm forecasting that we will see the March 2020 lows right across the board in all the major markets. I know a lot of folks are giving me some grief over that, but it's just what I'm seeing in the economy. I'm officially calling a recession even before the numbers come in. I don't see anything over the next 2 weeks that's going to change our GDP numbers. So I do believe that the end of June, we're going to officially log in 2 consecutive quarters of a contracting GDP. And so you see what's happening in China. They're in emergency mode right now. Their GDP is now dropping like a rock, and they are having a very hard time controlling that. If you look at Japan, inflation is out of control. They have not done anything with regard to raising rates. So the Japanese yen is again falling like a rock. I mean, it's all over the world. It's not just here in the U.S. And I think that domino effect will not only drive us into a hard recession, but it could bring us into another great recession, a deep recession. So brace yourself. Now, don't get stressed out about that. If you're planning and you know how to maneuver in this market, you can do very well on the way down. And I'm going to show you some things that are based on Dow theory that will help you relax a little bit in this bear market. So that's my forecast on DIA. Again, it's an upside target, very short term, 305.05. If I go and look at the Qs, which basically represents the tech sector, you can see here, once again, that target number was hit. Last week I put in 281.65, hit that precisely. Actually on Monday, a gap down hit that target. On Wednesday, we hovered around that target. But notice, remember that role reversal happening again. Former support back here turned to resistance right there, and the market turned down. See that? So that role reversal, that little zigzag pattern, it looks nothing more than this. A former support level broken turns into resistance. It's an ABCD pattern. We see it happen over and over again. Right here is another one back here. Former support turns to resistance. This is something that you can rely on. It's not a phenomenon. It's a common occurrence. Basically supply and demand on the chart. And so for the Qs next week, I do believe that we're going to move up. I'm not going to put an outrageously high target. I think we're going to move up right to that former support, which is now established as resistance. That target for the Qs is 281 to the penny, right on the mark, 281. And I'm expecting that by June 22nd. For you option traders, I have that little data box that pops up, see in the bottom right-hand corner. That's June 22nd. So your option traders, make sure you have your expirations on the weekly options, especially if you're trading weekly options. Make sure you give yourself enough time to capture that bounce. And again, it's a short-term bounce that I'm forecasting, nothing major. Eventually, I think we're going to turn hard to the downside and set new lows. Now that brings me to IWM. This is a Russell 2000 ETF. You can see once again that target was hit. We hit, by the way, on all counts, 100%. The second week in a row where we're hitting 100% on our targets. Hopefully you viewers are appreciating that and using this video report as a tool to help you gauge your positions throughout the week. But that was a target down there at 174.59. Had a massive sell-off over the last 2 weeks. Again, we broke out below that key support level. Therefore, what do I think is going to happen? Rally right back up to, guess what? Former support turns to resistance. There's the role reversal again. There, see the zigzag? Support broken turns to resistance, just like that. Memorize that. And then even go back and look at charts randomly. Try to draw your own role reversals. Go back and look at any stock. It doesn't matter. Former support turns to resistance. There we go again. See? And it just keeps going and going. Here, former support turns to resistance. This is IWM. You can look at Apple, you can look at Amazon, you look at any of them, Tesla. They're all going to have role reversals, both on the way up and on the way down. It just so happens that we're in a bear market, so the resistance areas are holding quite nicely when we trade back up to them. So again, forecast for next week on IWM is 171.77. Now let's take a look at the VIX. The VIX gapped up last week, and if you follow along and you track my guarantees that I make all the time on the VIX, when the VIX gaps, it could be up or down. It does not matter. You can see here the VIX gap down, and you can see that 100% of the time gaps fill. There we go. It filled back then. It gapped up, and on Wednesday it filled right there. Now, look at that candle right there, and you're going to see, as I magnify that, that is a bearish harami. A bearish harami is a very reliable bearish candle that is right up there with a bearish engulfing. You could see that back here was a bearish harami. See the little red body candle that shows up within the green body, the range of the high and the opening and the close on the green body? Here is a bearish harami. See that? Here is a bearish engulfing. So they're very reliable, and that tells me that the VIX has a greater chance of dropping than it does rallying. And where do I think the VIX is going to drop to? Yep, right there, role reversal. Let me erase this, and I will draw that for you right here. See that former resistance, which is now acting as support at a gap fill, I think will be tested again right here. So my downside target for the VIX is 29.59. And then I'm going to go out on a limb again and say after we bounce and pivot, I think the VIX is going to really start to take off. My target all the way to the left here, it's hard to see, is 41.88. That's my longer term target. I have not budged on that. I'm keeping that in place. And again, for the most part, the VIX is inversely related to the S&P. So if I believe the VIX is going to pull back, that means I believe that the S&P is going to rally. And what do we have here? Yep, we have another target that hit last week with my downside target of 384.72. We now have a doji right there. A doji is usually found like a spinning top. A doji is found at pivot points. Here's a doji right here. And here's a spinning top. The dojis and spinning tops are more or less cousins. Yesterday, we had very close to a hammer pattern, which is bullish. And today, that doji is on lower volume. So when you have prices dropping, please, the repetition, my redundancy is by design. And hopefully you're picking up on this because I have a trading checklist that our clients follow. And volume is a very, very important part of our analysis. So in other words, when you're seeing prices drop, if you see the volume drop on a lower low, that means that the sellers are losing momentum. And if you're a trader, you obviously don't want to be buying when the sellers are in full control. You want to wait until the sellers stop selling before you get in to a new long position. And that's exactly what we're seeing. Now down below, you see the CCI starting to hinge up and the stochastics is oversold. So if you're following my trading checklist, you have a doji at a low on a lower volume, that's bullish and bullish. We have gaps above the market. They'll act as price magnets. That's bullish. We have a wide divergence from that moving average called the rubber band effect. That's bullish. The oscillator is showing bullish oversold conditions. There we go. We're ready for launch. And again, I don't want to put my bullhorns on here, but I'm just telling you, I'm just looking for a little bounce. A little bounce before you start listening to all the JP Morgan, analysts that telling you the SPY is going to, go up to 480, right? The SPX 4800. I say, watch out for that. JP Morgan came out earlier this week, and one of the analysts said the S&P will go to 4800. Well, that word "will," I take things very literally. The word "will" is as close as you're going to get to a guarantee. And if people believe that, then they're going to be in trouble if they start buying here and then we're off to see a new low. So be really careful of that. We're in a bear market, and I'm going to show you exactly what to look for here. Right? So again, my upside target on this, I'm going to start right there at that little point that I just made. I'm going to say we're going to go up. Looking to the left as I draw to the right, there's a little bit of a gap here. My upside target on SPY is 374.91. 374.91. We have about 9 points to go on the upside, and then we'll have to keep an eye on volume. Now, again, for those of you who follow me long enough, you know that I am a diehard Dow theory guy. I love following Dow theory. And if you know anything about Dow theory, you'll know that markets move in trends. This is a representation of how the three phases work in a bull market and in a bear market. And we've obviously seen the bull market from the COVID lows of March 2020, all the economic stimulus that the Fed pumped in, really pumped this all in. Then we hit the excess phase. And in January 19th and January 28th, those were two separate reports that I put out where I called an end to the bull market right there. Now, where are we? We're in the first phase of the bear market. We're in the first phase of the bear market. Now, what does that look like? Well, here's where I think we are, right here on this particular chart. We're about to see a little bit of a bounce. I don't think it's going to be as intense as what the model looks like, but I do think we're going to see a bounce, and then I believe we're going to be right off to new lows right here. We're just getting warmed up in this bear market. If you want a little bit more evidence, look at this chart. What I've done is I've taken the diamonds. This is a monthly chart of the diamonds, so you can see how this compares to Dow theory in the three phases. Here we go. There it is. I took the chart that you just looked at describing the three phases, and I overlaid it on top of the actual chart. This is a current chart showing June right here, this big red candle, and that's exactly where we are, right there. You see? So now, what does that mean? Well, it means that you have to be very careful. Yeah, we can make money on a little bit of a bounce, but that means that if we're following this, even as I describe it as an ABCD pattern, you could take the top up here and have that as an A, point A, a pivot point lower, to B, at which time it pivots up, moves to C, and then the pivot lower generally moves to a lower low from B. we have not hit phase 3. We're a long ways off from phase 3, which is capitulation here. We're a ways away from that. Keep your eye on the news and what they're going to be talking about with this recession. When they label it as a recession, the Fed's going to come out and call it transitory. And then all the pundits are going to come out and all the spin doctors are going to try to spin this. Oh, it's not going to last long. And then it gets worse because people are freaking out right now at the pumps. They're running out of fuel in Colorado. I don't know how many of you saw that viral video of the trucker out there taking video of all the trucks that are stranded on the side of, I think it was I-70 up there. And all the gas stations on I-70 are running out of gas. And they're all stranded up there. What is that about? Why isn't that headline news? Well, it's happening. And people are freaking out about it. So they're not believing what they're hearing on the news. They're feeling what's happening in their gut and in their pocketbook. So again, that sounds really negative, right? And I do believe that we have an economic storm, a hurricane, in fact, coming our way. If you are prepared for it, just like we prepare for hurricanes in Florida, if you prepare for it, not only will you survive, but you could actually thrive in a down market if you're positioned properly. If you're interested in learning how to trade options, then I've said it before, I'll say it again, call Market Rebellion. They're not going to hard sell you. They're going to ask you, what are you looking for? They're going to match you, your needs with what they have in webinars and courses, and you'll learn a little at a time. There's still plenty of time to learn, even if you're a brand new trader. Just be calm, protect your money, use stops, right? If you think the market's going to go down and you're long, put some protective stops in. At least know how to move to cash so that you're not going to suffer the catastrophic hit in the capitulation phase of a bear market. You want to preserve that buying power, and if you can, if you learn enough, you could put that money to work on the way down, right? So again, all is good. I'm very excited. Some of you could hear it in my voice. Some of you have met me. This is authentic. This is not, pumped up. Oh, let's get talking about the market. This is real. This is real. I've never been more excited after 40 years of trading the market. 40 years. I've been trading since 1982. I got involved with the market in 1980, but I started trading professionally in 1982. I've been doing this for 40 years. I've never been more excited because this is our moment. People dream of having a market like this where they can capture profits. And again, it's not going to be easy. The process is simple. It's not going to be easy because you have to deal with your emotions. Once you learn how to control your emotions and focus on the charts by looking at signals, by reading volume, by looking at oscillators that are based on mathematical formulas, use the charts to help remove the emotions and give you a sense of direction, and then simply put your money in the trend and where the money is going, right? If you want to make a lot of money in the market, first don't lose a lot of money in the market, and then put your money where the money is going. That's as simple as I could make that. Remember, the simplicity is one thing. The level of difficulty is a little bit different if you're dealing with emotions, of course. The process is simple. It's not easy. Remember, those words are not interchangeable. They're very different. I embrace the simplicity, keeping it super simple. It's up to you to learn and feel comfortable with it. And again, I teach through repetition, so stay plugged in. Please like, subscribe, comment. Oh, thank you so much for those comments. Each and every week we have more comments coming in, more positive. Remember, positive is contagious. Positive attitude is very contagious, and all of you are doing that for all the other viewers. So again, thanks for the comments. Have a great long weekend. Remember, the markets are closed on Monday. We have a shortened trading week next week, and I'll talk to you next time. So long.
Hello, John Najarian here. If you want to trade like a rebel, if you want to party like a rebel, well, you got to come to RebelCon 2022. It's going to be in Dallas, Texas, at the fabulous Four Seasons Resort. We start the 21st of September, go until September 24th. It will be more fun and more live trading than we've ever done before. That's why it's called RebelCon 2022. We're going to have barbecues and double the amount of live trading. So if you want to book that now, make sure you do, because the guest speakers, as soon as we announce those, this thing's going to be sold out. It's going to be something you do not want to miss. Limited to 250 people. Diamond, platinum, and gold packages are selling out. Sign up now for RebelCon 2022 at the Four Seasons in Dallas, Texas.
Welcome to the rebellion.